Welcome to Crude Insights. I'm Tom Reed, VP for Crude and Products here at Argus. Whether or not your business has a direct exposure to China, everyone in the market is at least indirectly exposed to it. This is, after all, supposed to be the year in which China comes roaring back from its self-imposed 3-year purdah. Depending on who you talk to, China will account for anything between 40 and 50% of global oil demand growth this year. Is China really back? And if it is it back on the scale we all anticipated? So if we look at how China was performing in April, demand was actually running ahead of forecast. Here you can see on the one hand what we call apparent oil demand hitting in absolute terms a record high at the end of April, and on the other axis how that puts demand nearly 1.3 million barrels a day up on a year-to-date basis versus 2022. It's worth clarifying, however, that this apparent demand metric is a measure of supply to the Chinese economy. It's not a measure of demand. This quantifies how much refined products Chinese refineries are spitting out and how much the country's taking in on a net basis in the form of imports. What it doesn't do is capture stock movements, and those are a really important piece of the oil balance right now. Because Chinese companies began booking more oil for delivery to China as they came out of lockdown at the end of last year. At the time, crude was cheap. If you buy one in January, it doesn't get there until April. So strong April data are, to a large extent, the cumulative effect of rising imports since China scrapped zero COVID. Diesel is a key industrial fuel in China for manufacturing, transport, and construction. Going into the fourth quarter, you can see how demand in China was so weak and prices in Europe so strong that it actually became profitable to ship diesel all the way from China to Europe, far further than you would normally expect product cargoes to sail. But then look what happens. The arbitrage to Europe closes right off in February. And why was that? Well, Chinese trading companies, oil companies, began buying huge amounts of diesel from the local spot market. And that pushed prices in China way back above prices in export markets like Europe or even Singapore, which is far closer. And you can see in that chart on the right how spot trade absolutely ballooned in February because of really high expectations in China about the strength of the country's post-COVID economic rebound, driven by a boom in infrastructure investment during the spring construction season. But due to poor weather, high levels of corporate and local government debt, that boom has not yet materialized. Those diesel supplies became stuck in storage tanks rather than being consumed as a fuel for the economy. So now we're in a situation where after a really very strong first 4 months of the year, China's essentially in a destocking phase. It needs time to absorb all the oil that it bought in December, January coming out of lockdown. And we see that now showing up in the lower volume of crude that it's been buying for delivery in July, August. Atlantic Basin sweet crude prices, and here I'm referring to the Argus 2P delivered China differential to ICE Brent, are trending lower, and they really are setting the pace for other prices in the market, including sour crude differentials, which you can see here with the formula price for Saudi Arab medium converted into an equivalent ICE Brent differential. Because Chinese demand has been running ahead of where it should be, and the market is now in a destocking cycle, we're likely to see, in the short term at least, further pressure on crude prices before balances in the second half of the year start to tighten again. So that's a snapshot of what's happening in the Chinese market. If you would like more information, please do click on our website, argusmedia.com, and have a look at our Chinese report, including the Argus workspaces. Thank you very much.